All right, guys, welcome to the advanced coaching call. Today, our topic is going to be looking at how exactly do we come up with a valuation when looking at a company. Now, ultimately, what we said, and we've been saying this from day one, if you don't pick really good, high quality companies, it is going to prove to be a problem down the road. Okay, so that's the first and foremost process of the theta strategy. I'm joined today with with Danielle today. Danielle Nadim is our full-time analyst, and he analyzes these companies all day long, all day, every day. So
Yeah,
he,
hi everyone.
how you doing, Danielle? And today we're going to
Fine.
go over exactly what is happening and how did we come up with a valuation for Nvidia. So again, remember this: ultimately, a stock will go up and down long term, not short term, but long term, depending upon the profitability of that company. So, in the short run, things like tariffs, i.e., what we're going through now, can vastly affect the price of a stock. However, long term, good afternoon, Cam.
Hey, how's it going?
Excellent. How are you? Just letting everyone know what the topic is today. So ultimately, long term, what determines a stock price is going to be the amount of money that company makes or doesn't make. And what I mean by long term is, a year and greater, but probably even 18 months or greater. Because in the next 12 months, let's say these tariffs persist and it causes all kinds of uncertainty. The markets don't like uncertainty. So one of the things that we'll go over in the discussion today is going to be the multiple that one applies to the amount of money a company makes. So if a company makes $1 a share and you apply a multiple of 10, or let's say you apply a multiple of 20, excuse me. Okay, because that's kind of typical of what the S&P is, long run. You apply a multiple of 20. But if you're in a bad macroeconomic situation, i.e., tariffs, unknown nonsense going on, the market gets a little jittery. And it says, you know what? I'm not willing to pay 20 times earnings. I'm willing to pay 15 times. And all of a sudden, you have a correction. And I think that's exactly what's going on right now. So a lot of it's subjective because remember, ultimately the stock market is in the short run an amalgamation of human emotion. If humans are in a good mood, stock market will be on the high side. If humans are in a bad mood, if there's a war going on, something like that, tariffs, unknown political situations, then the multiple will be lower and people will be a bit jittery, right? But remember, long run, it's going to be based upon the amount of money that company makes or doesn't make. That's quite simple. If the company you're investing in doesn't make a lot of money, doesn't have lot of prospects of making a lot of money, it doesn't really matter if there's tariffs or not tariffs. It's not going to do terribly well. We want to look at companies that are not only doing well today, but we can look at how are they going to do in the future. So today we're going to, and we haven't released a whole lot of research reports. They're going to start coming out a lot more frequently on a go forward basis. Now that Danielle is done his CFA level 3 and hopefully he has passed. But we'll have to see. His results come out at the end of April. We're going to be going over Nvidia. So Nvidia is one of the biggest companies in the world, and it is the one of the leads for this whole AI revolution, right? For example, Nvidia doesn't make their own chips. Taiwan Semiconductor makes the chips for them. However, they design the world's best chips. And they have a great software called CUDA. This is their main business, which is integral in running those chips. Now, as you've seen, there is an insatiable demand for NVIDIA's chips. Um, all the Magnificent Seven companies are buying them, except for Apple. Apple makes their own chips. But basically, there is an insatiable demand for NVIDIA chips. Why? Because we are in the age of artificial intelligence. All kinds of data needs to be processed. Large language models need to be trained. This is data. So I'll give you an example. The Tesla I always use the Tesla example. Every Tesla is equipped with, I believe, 9 cameras. Okay, 8 external, 1 internal. Maybe not all of them, but at least the newer generation ones. Now those cars are constantly collecting data. It's looking at, if you have 6 or 7 million Teslas on the road, they're all collecting data. So as you're driving around, it's looking around. How is this person driving? Why are they driving this way? What about this road? What about freak accidents, weather conditions, all kinds of things. So they take all of this data, and this data now it's in the billions of miles. It's about 3.5 billion miles of data. They said they need about 6 billion miles of data to solve full self-driving. So now let's say you have 3.5 billion miles of data. In that 3.5 billion, you're going to get, freak situations like a landslide, like a rock falling off a cliff, a pedestrian cutting in front of a car, a tire flying off a vehicle. All kinds of things are going to happen in that 3.5 billion miles. So what it does, you're taking all that data and you're training that software, full self-drive, to act and behave like a human driver would. How is it going to know to act and behave like a human driver? Well, the only way it's going to know that is by observing human drivers in various situations. Okay. So you take the 3.5 billion miles of data that you have so far, you then get a data center, okay, and you start training your large language model, which is full self-drive. Now you have to analyze all of that data. That data requires the better your processor is, the GPU, and NVIDIA has the best in the world. AMD is second fiddle, but there's enough business for both of them. As those are trained, it will start acting and behaving like a human driver. And as more and more data comes in, more and more data is analyzed by these NVIDIA chips, the driving system will get better and better and better. That's just one example. Another example would be, let's say, for example, I think one of the things we all hate is calling Bell or Rogers to change something on your plan. I despise it. It's the worst because an hour of your life is going to be consumed. Now, you have to call Bell or Rogers or TELUS or whoever it may be. In the future, are you going to need customer service agents when you can train artificial intelligence to have a voice, to act and behave like a human based upon all the recorded calls they have? So when you call in, they say this call is being recorded for quality assurance. Okay, that's part of it. But the other part of it is they want to analyze, what did this human being do? How did they resolve this issue? So if you call in and say, hey, I want to change my internet plan, okay? I want to change the payment method, or I want to add a phone, or whatever it may be. It has to know. So it has to have a lot of situations where you have irate customers, you have customers who are unreasonable. It has to go through all of that data. And the more and more calls it has, the more data, again, that needs to be analyzed. Again, that data is analyzed with NVIDIA chips. So the better the chip, the more efficient it analyzes it, the less energy it uses, the faster it can get it done. That's why the chip war race is such a big deal globally. Whoever controls artificial intelligence will have economic dominance for the next who knows how long, 50, 100 years. And this is why, for example, these chips made by NVIDIA, their best chips, the Blackwell chips, they are not accessible to Chinese companies. And the US is doing that on purpose because they don't want the Chinese competing with them. So they offer NVIDIA's the older chips that are not as good. And why is Taiwan Semiconductor so important? Well, they're the only company that can manufacture the chips. Again, NVIDIA does not manufacture their own chips. They only design them. Taiwan Semiconductor is the only company in the world that can manufacture chips that efficiently and has that technology. So a chip at the end of the day is a silicon wafer. And then this laser imprints millions of transistors onto this chip. The more transistors in the least amount of space, the more efficient that chip is. The more data it can process, and the cheaper it can do it with, because it's less energy consumption. So this technology is super valuable. So you have to ask yourself a simple question. Now that we're moving into the age of artificial intelligence, how much data needs to be processed globally? I don't think anyone knows the answer to that, but we know it's a lot. a lot of things are going to change over the next number of years. NVIDIA literally is the leader in analyzing all this data globally. So you've heard of this thing. We've done coaching calls on this before, of data centers being built everywhere right now. And they also require huge amounts of electricity or energy. Okay. So one of the reasons that Donald Trump and the Republican Party is pressuring Canada is because they know we have the natural resources to power these data centers. We also have a cold weather climate because they emit a lot of heat. So you generally want to have them in a cold weather climate. And you also want to have a good fresh water supply close by. So Canada is ideal for that. So now that you know all that, let's take a look at where we think and how we come up with a valuation on NVIDIA. Now, like I said, a lot of research reports are going to be released in the next little while, starting with NVIDIA. Danielle, when is NVIDIA's research report being released?
It was released this Monday, so like 2-3 days ago.
Okay.
It's literally live right now, guys, on the learning portal. I just it's just been uploaded, so there you can see this report if you log into your learning portal right now.
Excellent. Okay, I'll turn it over to you guys. Let's take a look at this research report and see how did we come up with a valuation. And this gives you a lot of comfort when you're buying a stock, right? So NVIDIA, it was up to about $153, $154, went all the way down to about 105 in this latest correction. And now we're sitting at about 118, 119. Okay, that's short term. Remember, that's things like tariffs. It's exactly what that is. But what do we think it's going to be worth, and how do we come up with this valuation? That's why it's so important. So turn it over to you guys.
Where do you want to start,
okay,
Danielle?
Yeah, so like, do you want me to open the financial model, like to tell how did I arrive at this valuation?
Yeah, totally. I think, like,
Sure.
just to like, while you're doing that, I'm going to just like maybe talk about the like where things are at with NVIDIA right now. Like, here's the 5-year chart just to kind of orient ourselves. You're at 118, it's trading at today. And just to give us a little insight into what you want to share do you want to share the report, Danielle? How do you
Yeah, I'll share the model. I think like,
yeah, let's just share the
okay.
model.
Yeah, I'll share the model. And like to start off, I'll reiterate Omar's point that market may take the price of a stock anywhere, and there are noises and there are other events that are taking place, like what is the monetary policy of the country right now, what is the political situation. So right now in the US there's a lot of talk of tariffs, and that's why the prices of these stocks have fallen. But the main point when we are constructing our financial model is the concept of intrinsic value. And intrinsic value is the value that dictates the fundamental process of a company. Okay, the price can always fluctuate around its intrinsic value, right? Which is what's happening with NVIDIA right now. But this gives an investor a chance to earn a return. So for example, if the intrinsic value of NVIDIA that we came up with right now, the base case is $165, and NVIDIA right now is trading around $120. So that gives a chance of a return, to earn a return, because ultimately what would happen is the price of the stock would come to its would arrive at its intrinsic value, because that's what the fundamentals of a company dictates. In the short term,
basically, Danielle, what you're saying is the stock's currently trading for 100, let's call it 120.
Yeah.
And you think it'll be worth 165. Ultimately, the reason is because you think this company is going to make more money this year than they made last year, correct?
This year and like going forward. So
and
like in going forward. So like
right.
What a DCF is, it projects the income statement of a company, like revenue and earnings.
So 5-10 years into Danielle, if you could just define, a DCF is a discounted cash flow model. This is the basis that all Wall Street analysts, Bay Street analysts, this is what we're taught in school in finance, and when Danielle was doing the CFA, this is the basis when you come up with a valuation for a company. Now, not we're asking you guys to do this on your own because it is complicated and time consuming. But what you do have to do is look at the report and say, well, do I agree with this? Because there are assumptions in this report. You have to assume that artificial intelligence is going to be in demand. Therefore, NVIDIA chips are going to be in demand. These are certain assumptions you have to make. So once you agree with those assumptions, then we come up with that multiple, like I said, where, okay, each dollar of earnings is worth X amount of times. And generally speaking, the faster a company's growing, the higher the multiple. So if you're a company that's in decline, in a declining industry, you're not going to get a very high multiple, right? Which is like, let's say, for example, General Motors. General Motors sales are declining. Uh, the old internal combustion cars are, they're slowly dying off globally. Their market share is decreasing more and more each year. So the multiple that you would apply to General Motors would be very low, right? The multiple can also change based on geopolitical or economic factors in the short run. So we're going to take a look at where we think, okay, how much money did they make this year? How much did they make last year? And then let's project forward of how much they're going to make 26, 27, 28, 29, and 30. The further out that you go, the less predictable it is because there's so many more variables. What if there's a major war around the world? What if there's another pandemic? What if there's a massive housing correction somewhere? It becomes more difficult the further out you go. But to a large extent, if nothing really changes, we're going to take a look at how the technology is going to grow and what the demand for that technology and ultimately how much money NVIDIA is going to make. So let's get into it, Danielle.
Yeah, so like just before that, I would like to tell our audience is like whenever you read these news that like XYZ investment bank or whatever, they have increased their price target of a company, or they have reduced their price target of a company, that is because they have their financial model and they update the assumptions in that financial model. So everyone builds a financial model, essentially. Okay. Like now coming to the NVIDIA's how has NVIDIA done previously? So in 2025, like just this past year, NVIDIA made $130 billion. Okay. And the revenue grew by 114.
2024,
2024, but it was FY 2025. So like that's why. So 2024, the year that went by, FY, which they call it to be FY 25 because it ended in January. So they made $130 billion in revenue. And that was a growth.
So even though it's 2024, we're looking at results for 2024. Companies don't always report in calendar years, so they have something called a fiscal year.
Yeah.
Fiscal year is what Danielle was saying, FY, fiscal year. The fiscal year is actually defined as 2025. So their sales, Danielle, in 2025 were 130 billion. Is that correct?
Were 130 billion. Yeah. So the sales were 130 billion, and that was a revenue growth of 114%. And if you see that in the prior year, the revenue growth was even higher at 125%. That is like when the world came to know of AI and accelerated computing, and that is when NVIDIA took off. But as the case with any company, what happens is the revenue in quantitative terms keeps on growing, but in terms of percentage growth, it decelerates because as a company matures, this is the normal process. However, even if you see like a projection for the revenue of 2026, FY 26,
which is calendar year this year, correct?
Yeah, calendar year this year. So calendar year 2025, FY 26, fiscal year 26, it's 224 billion. And that is arrived because NVIDIA just started giving out its Blackwell chips in the last quarter. So the Blackwell chip is the next generation chip. And what is essentially being predicted is that not only AI, not only any other thing, there would be a complete transformation in computing. And by a complete transformation, what I mean is CPUs will become redundant and every computing would be shifted to GPUs. And for that, NVIDIA's chips, sorry?
Can you differentiate what is a CPU and what is a GPU?
Okay, so CPU is the terminology is central processing unit. And in that, the chips are not constructed parallel-wise. So there are chips, but they are not parallel. So when chips are constructed parallel, as the case is with a GPU, the processing is much faster. So the tasks get done much faster, and the memory of the overall computer is much higher as compared to a CPU. That's why if you go back 10, 20 years ago, all those gamers, like people who love to play games on their desktop, they used to have GPUs instead of CPUs because CPUs can't render those graphics on the computer. They need GPUs to process tasks faster. Okay, so now because of accelerated computing and because of everything, there would be a complete shift. CPUs would become redundant and everyone would be shifting to GPUs going forward. Okay, and NVIDIA stands at the forefront. There's a study that was done by Morgan Stanley, and I've mentioned that in the research report. Morgan Stanley predicts a 1.5 trillion opportunity in this space. And so if you can imagine how like NVIDIA is positioned in this space. Right now, NVIDIA is making strides in the data center because every company right now needs a data center that's much faster as opposed to the data centers that they used to have. Now, everyone is buying that. That's why all these hyperscalers like Meta, Microsoft, Amazon are buying NVIDIA chips. It's because of the fact that these data centers need to be quick. And if I just switch to the research report, I would like to show you a study that done by Morgan Stanley. That
if we just take a look at the at this, for example, Daniel, just go back a bit.
One second. I just wanted to show like how I have arrived at these projections for the revenue projections.
Okay, so for this year, you have projected that their revenue is going to be 224 billion.
Yeah.
For 2027, 308 billion. So it's still a very nice increase.
Yeah.
2028, 397 billion. 29, 474 billion, and 2030, 543 billion. So you understand, guys, in that there's a lot of assumptions in there, right?
There's a lot of assumptions, and one thing, sorry to cut you see the revenue is decelerating here. Okay.
Yeah, because
terms it's increasing, but revenue is decelerating, and that's normal for any company that enters the maturing phase.
Yeah, you can't grow at 50% a year. Like Microsoft is not going to grow at 50% a year, being one of the biggest companies in the world. Apple is not going to grow at 50% a year. They're not going to sell twice as many iPhones this year as they did last year. There's just not that many human beings. So you could still be growing, but your growth rate decelerates. But don't take that the wrong way. That still means you're making more and more money year after year, and a lot more, in fact. And that's what we have projected for NVIDIA. If they're going to do 224 billion in revenue this year, but by 2030, 543 billion, which is about what, 2.25 times as much. Do you think the stock price is going to be higher or lower? Probably a lot higher. So let's take a look, Daniel, how exactly you came up with the analysis on the price targets.
Sure, I'll show that, and it's pretty intuitive. Like, you know that as this opportunity becomes evident to everyone, there's competition that increases. Plus, there's saturation also. So initially, when you come up with a new product, like everyone goes and like buys that. And as like the company matures, everyone has that product. So its saturation is also taking place. So that's why this revenue starts decelerating. So I'll show you one important fact that was mentioned by Morgan Stanley and I've mentioned that in the research report. Here's the fact. So as per Morgan Stanley, the company is expected to ship 60 to 70,000 Blackwell servers in 2025. That is 2025 CY calendar year 2025 and FY26 this year. Okay. While the cost of each system is expected to cost between $2 to $3 million. Okay. So that translates into a revenue of anywhere between the least being 120 billion to the most being 210 billion. This is only related to the Blackwell architecture.
Yeah, this is only one segment of their business. This is not their entire business.
No, this is only one. This is only one product. So NVIDIA previously was selling its Hopper chips. So it would keep continuing to sell its Hopper chips to like players who cannot afford the Blackwell chips, right? So if I add these two things, and NVIDIA has its other segment, that's the gaming segment, that's mentioned. That's the gaming segment. It also like makes some money from its professional visualization segment and automotive also. It's making strides in the automotive segment as well now. So like companies like Tesla, there are other companies as well that are getting in touch with NVIDIA to get data center and make those autonomous vehicles, right? So that's why there is a huge potential for the company to earn revenue. And I was being pretty conservative with my estimate of 224 billion. It could make even higher than this, right? But
do you understand, guys, how you have to assume certain things. You have to assume that they're going to sell 60 to 70,000 of those. But as long as you believe in the story, but if something happens like Trump puts a tariff on data centers, I don't know, something along those lines. well, then we got a problem. Then that will have to get delayed. What won't get delayed is ultimately this will happen, but how quick it happens, what happens in the meantime, does interest rates go up? Any of that stuff could affect everything short term, but longer term, no, probably not. It doesn't stop the story from happening, and that's where the assumptions that you have to make. You have to assume that Nvidia will still be the leader. You have to assume that they're going to sell X amount of their Blackwell chips, and they have a newer chip coming out. In fact, on top of that, you have to assume that data centers are going to be produced left, right, and center. We have a question here I'd like to address before we move on from Dan. Good hearing from you, Dan. Just thinking, with computing speed the name of the game? Absolutely. Do we know any companies that are specializing in data storage? I don't really hear much about the sector. Daniel?
Yeah, so data storage. So to that point, there are three companies that data storage is basically having data servers that store data for other companies. So Amazon's cloud, Google, and Microsoft, they do that. But now, interestingly, NVIDIA is also entering that segment now. Okay?
So that's
Nobody knows that.
Yeah, I agree.
NVIDIA is entering that segment. Quietly, NVIDIA is buying data centers. And soon you will be hearing that NVIDIA is also in that space, and we will be having another component to our revenue, to NVIDIA's revenue, and that would be also a plus for NVIDIA. So NVIDIA has a lot of strides to make.
So Dan, that's not referring to the actual building of the physical data center. That's talking about the cloud storage, right? So for example, Microsoft is number 1, Amazon is number 2, and Google is number 3. We invest in all three of these companies because, again, we think it's a major growing field over the next number of years. As more and more data centers are built and more data is required to be housed, well, you need cloud computing. It needs to be stored in a server somewhere. And those three companies have the biggest lead. As Daniel was saying, now NVIDIA is making a foray into that market. Now, that Amazon, Microsoft, and Google, they control the vast majority of the market. So can NVIDIA make inroads into that sector? Yeah, they probably can, because it's a massively growing sector. But they've got a long ways to go before they can catch up to those guys.
Yeah, so even if they don't catch up or do anything, the important point for everyone to notice is that what Omar mentioned, you have to just multiply the earnings per share of the company with its multiple, okay? And that would translate to the intrinsic value. That is as simple as it can be, okay? So imagine this revenue gets enhanced even by 10 billion. That would add to the earnings of the company, right? So if you multiply those earnings by the same multiple, that is simple math. So if you had previously $4 of earning and the multiple was 20, so let's assume the price would be $80. But if another stack of revenue comes here and the earnings go up to $5, then you multiply 5 by 20. The share price goes up to $100. So by NVIDIA entering that space, that would be another positive. So that is these are key takeaways that I want everyone to notice here, because this model, it's complicated, but these takeaways, everyone can understand this stuff. And what I want everyone is to separate noise from news. Okay, so everyone, whenever they read the news and the coaching that I've got from Theta, they should be able to determine as soon as possible that, okay, this is the news, and that could add to the stock's earnings, and that would translate into a higher stock price, and they could invest on their own. Yeah. Okay. So coming back to the model here, so these are the revenue assumptions that were made, and after that, so revenue is the building block. So we start off by assuming something about the revenue, and those assumptions are built based on what the company has said and what the insights we have. And after that, we take gross margin and other expenses as a percentage of revenue, because we see the past trend, and we see what's happening in the past with costs and everything. And we also ascertain what the company is saying, how their costs would increase, or what do they envision their gross margins or their expenses to be. So that is how the net income of the company is arrived at. I wouldn't go into much detail regarding these, because we don't want everyone, and I don't think everyone would understand this, but essentially what's happening is, from revenue we take a certain percentage of everything to come up with the net income.
So questions? For example, Danielle, line 70 this year, you expect Nvidia to have operating income of 138 billion this year, correct?
Yeah, that is because of the
Can you
fact that
just highlight that? Yeah,
yeah,
138 billion. So last year, guys, it was 81 billion. The year before, 32 billion.
yeah.
And then look at the projections by 2030. 138 billion this year. Remember, the stock market's looking a forward-looking mechanism. It's pricing in today what it thinks is going to happen in 12 months. So it already knows, yeah, 138 is a good number. It makes sense. But what they don't know is, and they're not, and this is not priced in. Where will the earnings be looking forward? Now, if you believe that Danielle's assumptions are correct, so myself, Matthew, and Danielle, we all contribute to these research reports, mainly Danielle, but by 2030, the company is projected to have operating income of $365 billion. That is
Yes.
almost a threefold increase from where it is today. So you have to ask yourself, well, where do you think the stock is going to go? You know, that's and then we'll apply a multiple and we'll eventually come up with the stock price. Let's keep going, Daniel.
Yeah, so like one more important thing is that this higher operating margin, as what I was saying previously, is just a reflection of higher revenue. So operating margin, you can see here, last year the operating margin is the operating income divided by the revenue. Okay, so last year it was 62.42%. This year, NVIDIA just said that they might incur some other fixed costs, and that's why the operating margin would be a bit lower, but it's at 61.75%. It's not that far away. But you see, the operating margin is largely consistent with what has been happening, what has happened last year. Okay, so it's just a reflection of the higher revenue. So operating margin is just I would say like a spin-off of the revenue. Okay, now if I go down, the other important thing to mention here are taxes, because taxes take out a lot from a company's earnings. And that is why most
Danielle,
of these
that could change drastically as well if Trump says, "Hey, we're going to reduce corporate taxes by
exactly
10% or 15%," and to spur the economy on, well, then we'll have to change all of the tax assumptions, which would increase their overall operating income. So you see how these assumptions are all kind of moving parts. If that happens, we'd have to change.
So that is an interesting fact that you just mentioned, and that's why, like, before Trump was coming into power, all these stock prices were moving higher because people were changing these assumptions in their models. They were anticipating that there would be deregulation and there would be like corporate tax cuts, and they just, so what I have to just do here, I'm just showing it for the purpose of demonstration, that I have to just change this 13% and the price would change. Okay, that's how people change their models, and that's how price targets change. These assumptions are always moving parts, and that's how like everything changes. Yeah, so like we have been very conservative with our tax rate. So previously the tax rate was 13%. That was applied on NVIDIA, because NVIDIA is a global company. It's not only, not only sells in the US where the tax rate is around 17%, but it sells globally, and that it also gets tax breaks from other countries. So the tax rate applied on NVIDIA was 13% last year, but this year NVIDIA has envisioned its tax rate to be 17%, and that's why it's applied across the board to every year. But it could change, and if it changes, the earnings would increase. For example, I would show you the earnings for 2026 is 4.7. If I change this tax rate to 13%, it increases to 4.93%, right?
$4.93 per share.
$4.93 per share. So that's a huge increase.
I just want to talk about a couple things here, guys. There's a few things that can change, okay? So NVIDIA is making a lot of money, okay? They can do a couple things with this money. They can pay a dividend out. They can buy back their own shares. If they decide to buy back their own shares, there's less shares outstanding, which means the earnings per share, because there are less outstanding shares, would go up. Taxes can affect it. There are many things that can affect this number. But when you look on your Interactive Brokers app and you see PE ratio, and then you see forward PE ratio, the forward PE ratio is looking at 12 months ahead. So it takes an amalgamation of all the different analysts on Wall Street who have come up with a discounted cash flow model like Danielle has. And it takes an average of those. And it says, okay, well, these 50 analysts who are covering the stock, they think the earnings per share are going to be $4.70. Okay, well, then if it's $4.70, you divide it by today's price and you have a forward multiple. But what it's not going to take into account is the years beyond 12 months. And that's where the opportunity lies. So let's take a look, Daniel, how you think, where we think we're going to be in the years ahead with this company.
Sure. Yeah. So that's an interesting point that you mentioned. Okay. So like I was here at the earnings. Okay. So what we do is we apply a two-pronged approach. We not only
Daniel, just
multiply.
a couple of years ago, they weren't even making any money, right?
No, so like the earnings aren't here. They were making money, but it was like 4.3 billion of net income, 9.7 billion. Now they're making 72 billion. So like it's not even a comparison, because
Yeah,
like
it's night and day.
previously Nvidia was just thought to be a company that benefits gamers in terms of it sells GPUs, and like gamers buy those GPUs in order to do like gaming stuff on their desktops. And this AI opportunity wasn't known, and nobody knew of accelerated computing. That's why. Like, okay, so coming back to this, so we have like the street says the EPS of Nvidia for 2025 this year would be 4.55. Our
And that's
estimate is a bit higher.
Daniel, the street means the amalgamation of all
The
the different.
amalgamation, yeah, the amalgamation of analysts on Wall Street. They anticipate the earnings to be anywhere between $4.55 to 4.6. Our estimate is a bit higher at 4.7. Okay. Coming back to what I was saying, our approach is a two-pronged approach. We do a DCF and we also do a multiples approach. So what Omar was just mentioning previously was a multiples approach. Like we multiply the EPS by the multiple. So that's a multiple approach, but we also do a DCF. We discount the free cash flows. Now to arrive at the free cash flows, there's a simple financial math that has to be done. You add certain non-cash items to the net income and you arrive at free cash flows. Okay, so you add back depreciation because it's a non-cash expense. You deduct the working capital expenses and you deduct the capital expenditures. So this free cash flow is the cash flow that's left to the stockholders and the bondholders of the company. And essentially, you have to discount this back at the WACC rate in order to arrive at the DCF. So you might be asking me, what's a WACC rate? WACC rate is the discount rate that a company requires to earn every year. Okay, there's a whole math behind that, but the WACC rate for Nvidia is 11.15%. I think it would be like going out of context right now. I would say like it would be off topic to like tell how I arrive at the WACC of a company.
Weighted adjusted cost of capital.
Yeah, weighted adjusted cost of capital, but it would be like I don't think I should go over how I arrive at the WACC, but yeah. So like, okay, so 11.15% is the WACC of a company. So we have two-pronged approach, as I just mentioned. One is the DCF approach. So what happens in a DCF approach is the terminal value of a company is assumed. So a company is always assumed to be a perpetuity concern. Okay. So what that means is it's a going concern. It's assumed that a company will never cease to exist. It will always be in operation. So in order to come up with the terminal value of a company, there's a formula that was derived by Gordon, and it's called the Gordon growth method. And that's applied here, and that's discounted here. So after discounting and doing everything, our DCF for base case comes up with a share price of $150. So this is the DCF of what's the share price that's being arrived from the DCF model.
So this now, is a 12, Daniel, it's a 12-month projected price target based upon all the different variables we talked about on the DCF side, right?
No, just there's one important catch here. The 12-month price target, the 12-month approach is in the multiples method. Okay, this is accounting for the fact that the company will continue in operations for the unlimited time period, and we have estimated free cash flow for 5 years going forward, and we have applied a terminal free cash flow approach that we assume that what the free cash flows, if the company continues to be in operation, those free cash flows till like unlimited period of time would be 3 trillion. So it's assuming that the company will be a going concern and the company won't cease to exist, and the free cash flows would be this. This is a different thing as opposed to assuming that the company would be like what the earnings of the company would be in 1 year. That is the multiples approach. Okay, this is a different approach. It assumes that the company will not cease to exist and what the free cash flows would be till the end of period of time. Okay, so
when I'm looking at the research report, Danielle, because if I'm looking at the research report, which approach do you use?
Both. So I'm saying we take an average of both.
Right.
Okay, so when I arrive at the DCF, when I arrive the share price with the DCF, it comes out to be $150. Okay, so the second approach is the multiples approach. The multiple approach is that we figure out a forward PE of the company, which comes out to be, which we assume to be $25 because that's the PE of NASDAQ.
Not $25, 25 times.
25 times, sorry. So right now the PE of NVIDIA is 28.9. We are assuming in 1 year it'll be 25 because of like this noise that's going around, and that's like we are being very conservative with our estimate right now. The PE of NASDAQ is also 25. So we assume that the PE of NVIDIA would converge to its to the multiple of its index, which is the NASDAQ. Now, the earnings of NVIDIA, the forward earnings of NVIDIA are projected to be 6.66 forward earnings the year after this. Okay,
so not 25, but 2000.
Yeah, 26. Yeah. So you multiply this PE by the earnings, forward earnings, and you come up with the price of $166. Now you take an average of both, so the average comes out to be 165, and that's how the intrinsic values arrive.
So that's our 1 year price target, guys, and where we think the stock is going to be headed. That's a lot of upside from where we are today. So just to go over that again, we think they're going to make $4.70 a share this year. Now, a lot of things can affect that. If taxes are cut, on the plus side, if we hit an economic recession, maybe not as high. And if the market's in a bad mood because the economy's in the toilet, you can apply a multiple of 24.56. Maybe the multiple goes down to 20. There are so many moving parts short term. But long term, it becomes a lot more, it becomes more murky in your assumptions. But as long as you believe that the fundamental story hasn't changed, it is a good way to look at where you think the company is going to go long term. Just a couple of questions I want to address before we go on here. Dan says, true, I was wondering if the companies that are providing hardware for these data centers. Yeah, so Harminder had a great response to that. Dell, HP, Supermicro, Cisco, they're some of the peer players on the hardware side, 100%. It says, but Danielle makes a great point. These chip guys are starting to make their own hardware solutions beyond just selling chips. Yes, they are. And we're factoring that into our model. Okay. So as they become a bigger and bigger players into this model, we're factoring that in. Dave asks, is the multiple the same as the PE? Yes. The multiple and PE are two interchangeable terms.
Yeah, and one more important point that, sorry, Cam, you can like continue. Please.
No, go ahead, man.
Yeah, so I just wanted to mention one important point is that there are a lot of moving parts here, but the important point to consider is that we are very conservative with our estimates. So NVIDIA's PE right now is 28. There's a huge opportunity in the AI space. And to be very honest, when there's such a huge opportunity and the company is the biggest player in the most growth industry right now, the multiple increases. It does not decrease. But we have been very conservative and we have applied a multiple that's equal to the NASDAQ first. The second thing is that with our assumptions also, we have been pretty conservative. So I'm not guaranteeing anything, but it's a safe bet that NVIDIA's intrinsic value should be around 165 or something, because we are being very conservative. In the meantime, there could be noise which may keep the company lower than its intrinsic value, but eventually, if the company continues its trajectory, it will most likely achieve its come near its intrinsic value.
Cam, you had a question?
Yeah, I got a few questions, but
Sure.
This intrinsic value of 165, this is like a year out projection, is that right? Or what's the time?
It's a year out. It's a 1 year out because it's a 1 year out projection.
It's a year out.
This is what we expect the company to be trading at come March 2026.
And that's based on income and based on expenses and based on future projections on terms of sales. That's kind of what boils down in the DCF model that you work on here.
Exactly.
And how do you come up with those assumptions? Like, first of all, you look at the earnings report. So 4 times a year, the company releases earnings report. After the earnings report, you have an earnings call where the executives of the company talk about where they think the company is going to go. What are their sales going to be like? What areas of business are they going to do? What are their margins? All that stuff. You take all that stuff, and this is how you compile these assumptions. Now, if you think that, Wall Street is missing something, or, those type of things, that's where the opportunity is. And Danielle is being very conservative here. Danielle, if you were to change the multiple, let's just change the multiple to let's go to 28.9, the same multiple that we have right now. All of a sudden, it's not 165 anymore. It's 192.
And the multiple you're referring to is the PE ratio. Is that right?
That's
PE
how
ratio.
much someone is willing to pay for every $1 of earnings. So for every $1 of earnings, it's 28.9 times that amount. Okay, so again, if the company's growing really fast, people will pay a higher multiple. The reason is because look where the earnings will be in like 3 years, 4 years, 5 years.
You're buying the future, basically.
You're buying the future, exactly. But if the company's earnings are declining, that multiple might be 5. Now, let's say, for example, tariffs persist, the economy goes in recession, and the stock market's in a bad mood, and the multiple we apply is only 20. Daniel, let's go to 20. What happens at 20?
Right.
133. So you see how there's so many changing parts? So if the market's in a bad mood for a year because, let's say, all of a sudden we get inflation because of these tariffs, well, then can we apply a 25 multiple? No.
And
We'll
you,
have
and
to-
you said
we'll have to-
25 multiple PE ratio is the Nasdaq index,
Average.
essentially. That's the
Yeah.
average PE
Yeah.
ratio in the Nasdaq.
Yeah, and the reason we're being conservative is because NVIDIA is growing faster than the average NASDAQ company. So we're being conservative in this approach.
Exactly. We are being conservative, and I would like to show one more interesting fact. I think everyone would agree with me that the prices are depressed of the stock right now, right? So 119 of NVIDIA is a depressed price. Previously, it was trading at 154. Okay. If I change this price to 124, look what the multiple of NVIDIA was like 6 months or like 4 months ago, 37. Okay. So if like now it's 190, if I apply a 34 multiple, which NVIDIA used to trade at a few months ago,
37 is what it was.
34, yeah, 37, yeah. So 1 second, what's happened here? Why didn't it change?
Yeah, that's funny. It didn't change.
Yeah,
Something
I know.
wrong with the Excel spreadsheet. Is it just updating?
I don't know, 1 sec.
Well, while you work on that, so you see how this multiple can change at any time?
Yeah, so look
So
at this.
So all of a sudden, if you apply the same multiple that it was trading at this year, all of a sudden the value, the projected value of the stock would be 246. That's more than a double from where we are. Or yeah, it's more than a double from where we are today. And this is where that opportunity exists. Just because the stock market's in a bad mood, or the economy's in a bad mood, or some geopolitical crap is going on, that's not, and the stock price is depressed, that's the time to be opportunistic, not depressed about it. Be opportunistic because you know where the future is as long as you believe in these assumptions. Okay.
Yeah, this all goes back to the theta philosophy, right? Of owning high quality stocks that long run, and knowing. And so what we're dealing with now is like this like 10% correction in the market, and your projection there has these like a bull case, a bear case, and a kind of the middle range, right? There's these in your research report, Danielle.
Yeah.
It gives you this range of bear case, which is $141, the price target that you have, $165, and the bull case of $197 or $198. That's just a like standard deviation kind of thing. Is that all that is?
Yeah. So okay, I'll tell you. Okay, it's not a standard deviation exactly. So like what's happening here is that we have applied a scenario to like the moving parts here. So for example, the cost of goods of the company, the base case we have assumed that it would be 28% of the revenue, but a bull case is that the costs would be much less. It would be the 15% of revenue. Okay, And the bear case is that it would be higher. It would be at 30%. Okay. So what happened? And we have applied these scenarios to different costs, essentially.
So these are costs only?
And to revenue. And to revenue as well. And to
Okay.
revenue. So revenues assumptions are here. Okay. So we have applied these cases. So like it's assumed that in 2020, let me see, in 2020, revenue could grow by 80%, but it could even grow higher than that. So what happens here? So like I have this switch here. If I do a base case, every assumption would be going to the base case scenario, and the price would be 141. And this is like what would be the worst case? All costs go up, the revenue declines. There's like export control with China, and like there are tariffs, and Nvidia is getting impacted left, right, and center. Okay, so this would happen to the stock price of the company. It would be trading around 141. This would be the intrinsic value. Okay, now if I apply a bull case, the price would go up to 197. Okay, so this is the best case scenario for Nvidia. And I haven't just changed the multiple here right now. I've just changed the assumption. So the price could go up to $197, and that could happen if Nvidia's chips, the demand for Nvidia chips is much higher than anticipated. So the price could be 197 then. So the base case is the case, like what we're assuming is that what's happening right now will continue to happen in the future as well.
Man, I've got a question.
There's a lot of upside, almost 40% upside in the stock price from here, guys, based upon a base case scenario. Now, could a bear case scenario happen? Absolutely. But this is why you want to invest in these high quality companies, because if you write a put on something and it doesn't work out for you, well, you write covered calls, you wait it out. The whole idea is not to lose money. That's the whole point. And that requires not using margin. So if a bear case scenario happens and you use a lot of margin, all of a sudden the stock takes a 20% dip and you get a margin call, well, that's a spot you do not want to be in, because you will not be around to see that longer term thesis play out. We got a question here. Ron asks, are you doing any update for Tesla? Research from
Yeah. So Tesla is in the works right now. Yeah, I'm doing the financial model, and it's a pretty interesting thing. I would just like to mention here. I just did the autonomous vehicle thing. So I built out based on assumptions. That is all based on assumptions. The autonomous vehicle component of Tesla. And that's a really big opportunity. That's what I would like to tell you. So we can go over that model sometime around, and I would show you like what the autonomous vehicle thing looks like. But yeah, so I'm doing that. I'm building out the model, but it's a huge opportunity for Tesla.
How long does it take to build out one of these models, Danielle? You've got to.
So like Tesla's model, it's a bit complicated. I have to like quarterly project the car deliveries, and now I have to project what the autonomous landscape would look like.
Okay? And the energy business.
The energy business, it's already in the works, right? I have to like assume a growth rate on that. But the autonomous thing, you have to assume like what would be the FSD, what would be the uptake of FSD, okay? What would be the market share?
Those are big assumptions, right?
Yeah. So what would be the market share of Tesla in ride hailing? Okay. So everything regarding to that. So like, but it's a big opportunity. To be honest with you, I just projected something $20 to $30 billion in the upcoming year. And that's like a huge opportunity. So like it unlocks a huge price potential for Tesla. So that's what I'm working on right now. Tesla's report would be the next coming out.
I haven't asked a question that we all are looking for. Do you think Tesla's done dropping? Well, you see how short-term things. Why did Tesla stock go down so much in the short term? The reason it's gone down in the short term so much is because Elon Musk is becoming increasingly political and polarizing. That's not good for the brand. It's not good for the stock. The multiple all of a sudden goes down, right? There's bad sentiment around the stock. The brand gets damaged. So is it done dropping yet? Who knows? You know, that's the short term. The stock market is so unpredictable.
I mean, everything's been dropping though. It's not just Tesla, right?
Well, Tesla's dropped a lot more than everything else. Yeah, but you're right, 100%, Cam. Everything's been dropping. Just a quick question, guys. Does everyone have access to this research report on NVIDIA? We just want to make sure that you guys have access to it. It was released on Monday.
It was just uploaded today, Omar. So
it was just uploaded today. My apologies. I thought it was
there was a bit of a glitch in getting it up there. I just uploaded it myself before this call, so it's on there now.
It's on the learning portal, correct?
Correct.
Okay. So go ahead and access that and see if you agree with it. And then Danielle, when will the Tesla report be out?
Okay, so by next week end. Tesla's report would be out. So I'm just building out the model. I just have to do some work on the research and like I have to like craft the research report, the updated, and by the end of next week, Tesla's research report would be out. But I have to be pretty careful with this autonomous vehicle thing so that I do not jump the gun on that. So like that's why like it may take some time. Yeah.
Okay, thank you.
No worries.
Okay,
Yeah,
so Danielle, sorry, Ken, go ahead.
Well, just a quick question. Like, how does this differ from other analyst opinions on you know, you see analysts, you know, opinions out there, you get their assessments of the situation, right? Like, and you know, like, and how would they differ? Like, what
It's just the basic difference is based on assumptions. So their assumptions might be different from mine. That's the big difference. So they might be assuming, so like if I go here and I show you this growth rate of 71%, that's what I'm assuming. And analysts would be assuming a 50% growth rate, or some analysts would be assuming a 150% growth rate. So that's the difference. That's where the difference lies. It's all only based on assumptions.
right?
And like mostly, like I've seen analysts having like pretty polarizing assumptions, like one way or the other. So yeah, what we try to do is like the track record. If you could see the research report previously as well, the intrinsic value targets mostly get met because we are pretty conservative with our estimates.
That'd be an
We do
interesting
not,
study.
we do not do outlandish estimates like 150% growth rate or NVIDIA is in a big opportunity space or like that. So yeah, we're pretty conservative. So that's understandable.
Yeah, Ron asks, do analysts have ratings based on success?
Yes, they do.
They do, but yeah, they do.
Yeah, in fact, if you go into your Interactive Brokers app and you go under analyst rating, there'll be something called tip ranks there.
Yeah.
So you'll see how what the track record of each analyst is like. They'll have a star rating out of 5. So if you see a guy with a 1 or like a half a star out of 5 or some gal, it tells you they're not very good at what they're doing. But if you see someone who has a you know a star rating, a very high star rating, let's say like a Dan Ives or a Wedbush from Wedbush, or you know someone along those lines who has a very good track record, well then that means their assumptions in the past have been pretty accurate.
And does that measure their accuracy, or just that the stock what went over their assumption? Do you know what I mean? Like
their accuracy. So like they are what they do is they project what the earnings of the company would be in the coming years, and if the earnings are near that level, so that like translates into their accuracy.
right.
Yeah. So if you scroll down, you'll see analyst ratings, and then it'll see Refinitiv ratings, and then you'll see tip rank ratings. You can actually go to a website called tipranks.com, and you'll see the projection on the stock. And so if you see a certain analyst and they have a horrendous track record, that's somebody you probably don't want to be listening to, right? It tells you that, like, who wants to listen to someone who's been wrong all the time? It doesn't make sense. But if someone's been right all the time, well, that means their assumptions generally have been correct in the past, and it's reasonable to assume that they'll be mostly correct in the future. Okay. But something like Tesla, by the way, is so much harder to value, and that's why the stock fluctuates so much, because what people are buying the stock off of is based upon autonomous driving, humanoid robots. They're not real right now. They don't exist.
Yeah, it's just a concept right now.
It's a concept. How do you value that? Whereas NVIDIA, Blackwell chips do exist.
They exist, yeah.
Right? We know what the demand is, so it's a lot easier to predict a stock price for NVIDIA than it is for Tesla. But the trade-off for that is the upside on Tesla may be substantially higher than the upside on NVIDIA. So may the downside if none of these happen. If no robotaxi happens, no humanoid robot happens, Tesla stock is not going to do very well, okay? But if they do happen, then today's price would be a fraction of where it would be in the future, okay? So these are assumptions you have to make. Danielle, let's take a look. Let's just take a look at the bigger picture, okay? Because what we want people to look at is take a look at the research reports you get. So Danielle, let's take a look at our price projections this year, the year after that, okay?
The price
says here on Tip Ranks, 42 analysts have an average stock price of 172 on NVIDIA. So you can see it's not far off from Danielle's.
I've never seen that price target.
Yeah, we like to do our own research. We don't like using other people's research. First of all, you don't get the research; you just get the end result, right? 172. Okay, well, how did you come up with this assumption? So we want to do our own research based upon our own analysis and our own assumptions. That makes you free of any biases, right? Let's say, for example, you're Bank of America and you have investment banking relationship and you're doing an merger and acquisition for a certain company. Let's call it General Motors. Are you going to give General Motors a poor rating? Probably not. And that's where these biases sometimes come in. So we like to do our own research independent. Now, it takes a long time to do, but we think ultimately doing our own research will prove beneficial for us long term. Okay. So Danielle, let's take a look at where we think the price targets are going to be in the future.
Okay, so like when we do this financial model, the price target is for 1 year only based on this. So like for future, we have price target till the next of March.
Okay, so let's say, for example, go back to that the DCF model.
DCF model, yeah.
Okay, so let's take a look at let's just go down let's take a look at net income.
Yeah.
Okay, so that's the main thing you want to look at. Line item number 89. That's the main thing, okay? So this year, 116 billion. Okay? But by 2030, 306 billion. Daniel, let's apply a reasonable multiple to that $306 billion. So $12.36 a share.
Yeah,
Okay.
and if I just multiply it by 20, what's the average S&P multiple?
Yeah, let's try that.
Okay.
So let's say, for example, we're right in our assumptions. No one's going to be exactly right, but you have a good idea. So what Danielle's doing is he's taking that multiple and he's applying it forward. Okay.
Yeah, so $247.20.
And that's being really conservative because a 20 multiple is pretty low. What if we go to like a 25 multiple?
If I do a 25 multiple here, 309.
309. So now if you're buying the stock today at 119, your 1 year price target is 165. Let's say your 5 year price target is anywhere from 247 to 309. It gives you a large degree of comfort. You're like, okay, I don't mind holding the stock. Just because Trump's implementing tariffs doesn't change anything for me long term because I think this artificial intelligence thing plays out. And this is why coming up with these DCF models and understanding what the valuation of a company is the most important part of the process. It's the most important. If you get this wrong, nothing else really matters. Doesn't matter if you write a put on a company that's going down the toilet. You just got a bunch of garbage for cheaper. It's totally useless. So this is so important. So if you believe this assumption, 306 billion, and and it could be higher, it could be lower. There's a lot of variability there, right? And you apply the same multiples we're at now, a $309 price target from 119. That's a very nice return in the course of 5 years. Very nice return. And
yeah, very nice. Yeah, so like I would also like to tell everyone, please do see our risks as well. We have mentioned the risks associated with every investment in every stock, and those risks are individual to each company. And we also, so that's being very conservative. We just don't post all the highlights of the company. We also mention the risks, and we have to be careful about that as well. So do keep into consideration all the risks associated with any company.
So Daniel, let's look for the actual research reports that people get, that everybody gets, and let's take a look at, just so that people know how to interpret it.
Yeah. So do you want me to go over the risk section?
No, just the whole thing.
Okay,
I
sure.
looked at this report. How do I look at this thing? What do I say?
Sure. Okay. So first and foremost, these price targets I've just told how they're derived. They are one line. They are mentioned in one line here, but there's a whole lot of work that goes behind this. Okay. So here it's mentioned the price targets for you. Now, in the first highlights section, we mentioned what are the key highlights and these are individual to every company. So NVIDIA's data center segment, which every hyperscaler is getting on board with, it's growing by 100% each quarter, year on year. Okay. So yeah, and nothing could be better for any company. So this is a growth company, and this line tells the story. The NVIDIA's next generation Blackwell chips, as per its latest earnings. So reiterating to Omar's point, we go over the earnings call of each company. They have mentioned that their demand for their next generation chip far exceeds its supply right now. So they don't have enough chips as compared to the demand. So you can imagine what the revenue would look like. The other differentiating part to NVIDIA is its ecosystem. So its ecosystem of integrated hardware and software, with software being CUDA, which Omar mentioned initially, provides it with a significant advantage over competitors. Because the point here that I want to mention is that if you buy the hardware, if you buy chips from any other company, you still have to have the software in order for it to function. But this company has the overall integrated set, and people, it's a one-stop shop for all this AI and accelerated computing, and that's why people prefer NVIDIA as compared to any other company. I have mentioned here why NVIDIA's price target of 165 is. It's because it incorporates a high demand of its products and services due to large opportunities in the AI space. But having true to our whatever we say, there are risks, and one or two risks are that there may be supply disruptions. Supply disruptions in the sense that NVIDIA gets its chips manufactured by TSM, and TSM is essentially a company based out of Taiwan. So if there are some geopolitical tensions, or if there's something happening, there could be supply disruptions. There's this export control. Export control, as like Omar mentioned initially, NVIDIA has been barred to sell chips to China. It's more advanced chips, so that limits its ability to generate an even higher revenue. And other restrictions such as tariffs that could hamper its financial results. Now, coming down here, company management, we have just mentioned what NVIDIA does. So everyone should know, like the company that we are investing in, what it does essentially, and what's the top management. So who's the CEO of NVIDIA and what his educational profile looks like. Now, then we arrive at the growth catalysts of the company. The growth catalyst being, why do we, so what we mean by growth catalysts is that why do we see the company to be a growth company, and why have we assumed such high growth rates? What are the main drivers behind that? So like as per Cube, I just mentioned one point, everyone can read the research report after this. As per Cube research, every layer of the technology stack, including compute, storage, networking, and software layers, will be re-architectured towards accelerated computing and AI-driven workloads in the upcoming time. So
now, Daniel, we don't need to go over every single point, but the point is, you got the growth catalysts. Okay, so you have to either believe those are growth catalysts, or you don't have to believe it. That depends on you. We want you to take this research report and either agree or not agree. Right? So you say, okay, yeah, this makes sense to me. I think these guys are onto something. I think this makes sense. And then you say, okay, well, I'm going to write a put on this stock. I'm very confident. And if that thing happens to go down a bit because Trump announced a new tariff tomorrow, well, don't panic. Don't freak out. You know what the longer term issue is, right? You know where the longer term trajectory is. So that's how you interpret these research reports. Danielle, how quickly will you be sending out these research reports, and which companies do you plan on doing in the near future?
Yeah, so Tesla's obviously next. After that, like I would be open to our audience asking me like what research report they want next from our portfolio. That would be would be an interactive thing. That would be an interactive thing. Sorry, which one?
He wants MicroStrategy.
MicroStrategy. Okay, yeah. So we can do MicroStrategy after that. That would be an interesting thing, and our that would be an interactive sort of thing. They can our audience can post like whatever they want, and that would be the next research report coming out.
Yeah, it looks like Tesla, AMD. Ron, I'm not sure what you got TTD there. I'm not sure what that is exactly. If you want to just specify, but the companies that Danielle will be doing will be the companies that are held in the Theta Alpha portfolio. So it'll be Amazon, Google, Microsoft, Tesla. As you can see, a lot of work goes into each one of these research reports. Like they literally take a couple weeks to do. It's a lot of work. AMD will be there. Taiwan Semiconductor will be there. Google will be there. These are all companies that research reports will be coming out for in the very near future. Okay. So then you can now you know how it's derived. Now you have to look at the assumptions and all that stuff and say, yeah, I agree or I disagree. And then if you write a put on it, and also another why this really helps too is oftentimes people sell stock way before they should. So let's say, for example, we came up with at a 25 multiple in 2030, at $12.36, I believe it was, per share on Nvidia. The stock would be worth roughly $309. So let's say you put on Nvidia at 119 or 120 and you get it signed, and it goes to like 180. You're like, oh, I'm out. Well, why are you out? If you think it's going to 309, don't be out. Wait, let your thesis play out. And this is, there's a book here, One Up on Wall Street, by Peter Lynch. It said it's one of the biggest mistakes that investors make is they don't let the theory or because they don't know what they're doing. They don't let the long-term thesis play out. So, for example, it's going to be very interesting to see Tesla's research report. We think there's a lot of upside on Tesla. Okay. So if you buy Tesla currently at $235 a share and it goes to 400 and you're out, and then it winds up going to 2,000, you're like, oh my God, I sold out at 400. Well, then because you didn't understand the company. That's the purpose of these research reports, to get you guys to really understand the companies inside and out. So when you invest in them, you do so with a high degree of safety, and you know longer term where that stock is headed. Okay, or have a very good idea. Ron says Trade Desk. Ron, we probably won't be doing Trade Desk. Don't know much about it. Like I said, they do take a lot of time to do these things. So yeah, it'll be mainly the companies that are in the Theta Alpha portfolio and a couple more. Dan says AMD would be interesting to see based on how much it went down over the last little while. Yeah, AMD is a great example. I think that's the one maybe we should do after Tesla, Danielle's AMD.
Sure. Yeah, AMD
peaked at $227 a share, went all the way down to like 98. That's a huge haircut. That's like 60% decline. But it could also be the opportunity of a lifetime if you know what you're doing. Right? So that's the idea behind these research reports. They'll be coming out pretty quickly. Cam, is there a mechanism? Are they disseminated via email, or is it just posted on the portal?
The research reports are just on the portal.
Yeah, but how would I know that a research report is ready? Is there an email that goes out to me?
Yeah, through ActiveCampaign, there's an email that goes out that is live, the research report.
Excellent. So guys, you'll be seeing a lot more research reports. So just wait for the email notification saying, okay, well, a new research report is, and then you go ahead and look at it, agree or disagree. This is the wonderful thing about investing. And I think in the next number of years, there is going to be a tremendous amount of opportunity for the people who are willing to be patient. Now, again, remember, short term, anything can happen. Let's say April 2nd rolls around, Trump doubles the tariffs, plunges the economy into a recession, kills jobs left, right, and center. Well, then, yeah, you got a problem short term. But it's not going to change anything long term. Things will get back to normal. They always have in the past. And that's the difference between Warren Buffett said it best. Short term, the stock market is a popularity contest. Long run, it's a weighing machine. The weighing machine is weighing based upon earnings. Now, one research reports that I don't know if you can't really do because it's a different beast altogether, would be Bitcoin. Okay, so Cam and Wasim are going to do a talk. Cam is an expert when it comes to Bitcoin, okay? And so is Wasim. So for those of you guys joining us tomorrow, we'll have a really nice discussion on Bitcoin and, to a lesser extent, other things crypto. But the reason you cannot do a research report, a discounted cash flow model on Bitcoin is because it's not that thing. It's like doing a research report on gold. Well, gold doesn't have earnings. Almost companies have earnings, and that's why they go up or down. Bitcoin is a different beast that way. The reason it goes up or down is purely based upon supply and demand. So the assumptions that we'll be making on Bitcoin is, well, how much supply is there? And then how much demand is there? Once we've determined that and we look at things like M2 money supply, then we can come up with a few assumptions on where we think Bitcoin will be in the future. But it's not the same thing. So we will not have a research report on Bitcoin, but we will definitely go over this topic. So any closing comments here, guys? I'm really looking forward to your Bitcoin presentation tomorrow, Cam.
Yeah, it's going to be a lot of fun. I look forward to that. I mean, all I'll say about Bitcoin is it, represents the underlying of, MicroStrategy. It represents the underlying of IBIT.
Yep.
A lot of ETFs and, yeah, it'll be a lot of fun. I'm looking forward to it tomorrow, and I think it's something we should be talking a lot about, because I think it's a lot of people are interested in it, and it's a changing world out there, and if you're not, you want to be abreast of these things. You want to know what's happening. So at the very least, understand it and decide whether it's for you or not.
Absolutely. All right, guys, thank you so much for joining us. We're a little bit over time, so thank you for joining us. Hope you guys learned a lot. If you guys would let us know, was that helpful? Was that valuable? Do you guys understand now how companies are valued? We want to get a lot more into looking and analyzing the companies in the coaching calls this year. So let us know if you found that to be helpful and useful. We think it is. And watch for those research reports, and then invest with a high degree of safety. And for those of you guys joining us tomorrow, Bitcoin and all things crypto will be the topic. We really look forward to it. Thanks for the comments, by the way. Appreciate it. Dave says, all right, thanks, guys. Ivan, good to hear from you. Dave, that was great. Looking forward to more. Rick, great insight. Fantastic. All right, guys, we will see you tomorrow. Thank you for Danielle and Cam for joining us. Much appreciated. Cam, really looking forward to your presentation tomorrow, bud.
See you guys. Thanks, Danielle.
Thank you. Thank you. Bye. Take care.